The difference between a rich person, a middle class person, and a poor person financially is that a poor person buys dumb things with other people's money. A middle class person buys dumb things with their hard earned money, and a rich person buys dumb things with easy earned money. Let me explain. See, what the average person does, the middle class person, is they are working to make money to do one thing: buy nicer things. The average person is working harder to drive a better car, to earn a bigger home, and to go on nicer vacations. Poor people, people who are not financially successful, want the nice stuff. Everybody does. And when you don't have the nice stuff, or when you can't afford it, what do? You put it on your credit card. Now you're having somebody else pay for that stuff, and now you have to spend the rest of your life paying off the Gucci, paying off the vacations, paying off the car. And so now you're playing this payments game where you have some of the nice stuff, but you're not buying it with your hard-earned money. You have to pay it back with your hard-earned money. But what rich and wealthy people do is they still buy that nice stuff, but they're not using their hard-earned money to buy that stuff. They're using their easy-earned money to buy that stuff. And what I mean by that is they go and generate an income, whether it's at their job or whether it's at their business. Does not matter. You go to generate this income. Then you take this income, and instead of going out and buying a new car, buying whatever stuff you want, you go out and you buy assets, something like rental properties, something like dividend-paying stocks, something that pays you with cash flow. Maybe it's even businesses. You make money, you buy assets, and then these assets will produce an income. And if it's in the form of cash flow, now you produce a new stream of income that's paying you every month, every quarter, every year. And then they use the money that their assets pay them to then go out and buy that dumb stuff. So what is a dumb item? Well, dumb things are things that do not put any money in your pocket. Your clothes, your shoes, your cars, your vacations, your home. All these are dumb expenses. Now, I'm not saying don't buy any dumb expenses. I'm saying if you want dumb stuff, make sure you can afford it. Because all these things are known as liabilities. Liabilities are things that take money out of your pocket and don't put any money back. Assets are things that you buy for the purpose of making money. And what wealthy people want to do is they want to make money to buy assets and then use these assets to buy liabilities. What the average person is doing is they're making money and then they're using this money to buy liabilities. And then what poor people, financial poor people, are doing is they're making money and then they're financing these liabilities. Now, when I talk about your home, the reason why I talk about your home as this liability is because most people believe that your home is the biggest investment ever. If you are a realtor, you've probably taught this. This is what I was taught when I went through my realtor training. Mortgage brokers will tell you the same thing. But the reality is, your home is only an asset if you can sell it for a profit. But until you sell it for a profit, when you buy that home, not only do you have to make the mortgage payments, but you also have to pay for all the upgrades. You have to pay for all the maintenance. You have to pay for the property taxes. You have to pay for the insurance. You have to pay for the HOA. And you have to pay for anything else to take care of the property. And then you have to hope that you can sell it for a profit, which maybe you will be able to, maybe you won't be able to. We have seen the real estate market go up and down. 10 years ago, we were in a very down real estate market. Today, we are in a up real estate market. So real estate goes to cycles just like every other asset class. And if you are in a neighborhood or you're in an economic cycle that happened to be hurt when it comes time for you to sell and you have to sell it, you might end up losing money, especially when you factor in all the other costs that you had to pay to maintain that home. Now, I'm not saying buying a home is bad. I'm not saying that you shouldn't own a home. What I'm saying is if you want to buy a home, fine. Just make sure you can afford it first, because what ends up happening to so many people is they go out and buy a home thinking that this home is going to make them wealthy, that one day I'm going to pay down this home and pass it on. That's going to be my generational wealth, which is okay, but that's one of the worst forms of generational wealth that you can have, because if you are sacrificing your ability to actually invest money just so you can make a mortgage payment, you are buying a home the wrong way. This home is now a liability for you because now you no longer have the ability to go out and buy rental properties. You no longer have the ability to go out and invest in stocks. You no longer have the ability to go out and buy businesses or whatever it is that you want. It does not matter what investment you want to buy. But now if you're living paycheck to paycheck because you got to worry about making the mortgage payment, well, now you're doing it the wrong way. And this is where everybody says, well, I'm building equity in my home. Okay, let's talk about that for a second. Did you know that your mortgage payments are front-loaded, meaning if you go out and buy a home today with a mortgage, most of your mortgage payment is going to be going to interest in your bank's pocket today and tomorrow and the month after that and the month after that and the year after that and the year after that and the year after that. For the first about 14 years of your mortgage, the majority of your mortgage payment is going to be going directly into your banker's pocket with interest and not equity. It's about 14 and a half years into your mortgage, your 30-year mortgage, that now at least half of your mortgage payment is going to be going to your principal. So for the first almost half of your 30-year mortgage, most of your monthly payment is going just to interest. It takes about 15 years before you start making any significant contribution to your actual equity balance, or the majority of your payment going to the equity balance in your home. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. Is it bad to buy a home? No. But do not stretch yourself too thin to go out and buy a home, because what I would rather you do is I would rather see you stretch yourself thin to go out and buy more assets, to buy more investments, because that's what's going to make you wealthier in the long run. I met a guy at this conference that I was at recently, and he was talking to me about this problem that he had. He said, I'm running into a lot of financial difficulties, but they're very unique financial difficulties. I said, tell me more. He says that I am a very aggressive investor. I said, I like the sound of that. He says, I invest pretty much every dollar that I possibly can into cash flow producing assets like dividend paying stocks. I said, I like the sound of that. He said, the problem is I sometimes don't have enough money to eat. He's like, I came to this conference and I didn't have any money to pay for my parking meter. But at the same time, I got a notification on my brokerage that I got a dividend payment this morning. I said, well, you've already tackled the most difficult problem, because the most difficult problem for most people is getting that mindset to invest and then taking action to put your money to work and staying aggressive on it. Your problem now is you got to figure out how you can make more money, because what you've been doing is focused on just squeezing more pennies out of this pie. Where if you make $50,000 a year, you save and invest $10,000. Now you're spending 40, you're saving and investing 10,000. And then what happens to a lot of people is you say, wow, I like this investing thing. I like this idea of being able to build my wealth and grow my savings and grow my net worth. I want to do more. So what do? Instead of saving and investing $10,000, now you do $15,000, maybe $20,000. Now again, you're making $50,000 a year. Now, if you're saving and investing $20,000, you're only living off of $30,000, but you're investing a little bit more. It takes time for your money to compound and really grow, but there's a limit to how many pennies you can squeeze out of this limited pie. Because at the end of the day, a penny saved is just a penny. And once you understand this is a good problem to have, because now the next part is where things get really fun. Because now what you want to do is focus on the income side. This is what we were talking about earlier. How can you take this from $50,000 to $500,000? Because now, if you follow the same ratio, you can now live off of $300,000 and save and invest $200,000. You're saving and investing way more, but you also have way more money to spend. And this is where now that financial education is so important to understand. Number one, the key to becoming wealthy is to not spend your hard-earned money buying dumb things. Meaning, do not spend your hard-earned money to buy things that are losing you money. Use your assets to buy things that will lose you money. If you want to buy nice things like a watch, fancy car, fancy vacations, good. It's a motivation for you. But use your money smartly. The more aggressive you can be to buy these assets, to buy the cash flow, the sooner that you will be able to afford the crazy stuff, the fun stuff, the dumb stuff without having to worry about the money. Now, does this mean you have to wait completely until you can buy it with your cash flow? No, not necessarily. But you have to make sure you're investing your money first. And this is where you got to figure out where on the spectrum are you. Are you going to be one of those people that's going to go all in and invest every penny possible and eat rice and beans until you can start making some real cash flow? Or are you going to start by making $100 a month into your investments? It doesn't matter where you start, but the key is that you have to get started. And this is where now you have to know, where do you want to go? Because once you know how to get there, the question is, where do you want to go? Because now you know wealthy people are working to have their assets pay for their lifestyle. Because now, even if you buy a whole bunch of dumb things, you got another check coming in next month, and the month after that, and the month after that, and this is money coming in without you even having to work. But in order to get that, you need the money to invest. So where do you get that money? Well, again, you can work through your job, or you can work to create your own income. But the key is that you have to be working to scale that income. That way you have more money to invest, because the more money you have to invest, the more income you're going to be able to get from your investments. When I first started learning about entrepreneurship and I first started seeing success in entrepreneurship, this is years ago now, I was so obsessed and I was so excited because I finally, for the first time, started making decent money. And if you want to quantify decent money, it was probably $200,000 or $300,000 a year as an entrepreneur from my own